Looking for high monthly income from the stock market, but without the roller coaster ride of the S&P 500? Today, we're breaking down one of the most popular ETFs out there, JEPI, the JPMorgan Equity Premium Income ETF. We'll cover what it is, how it works, the trade-offs, the risks you should know, and where it might fit in your portfolio. Stick around to the end, and I'll also share how JEPI stacks up against similar ETFs and what type of investor it's really built for. JEPI launched in 2020 and has quickly grown into one of the largest actively managed ETFs in the world, with over $40 billion in assets under management. Its mission is simple: provide investors with consistent monthly income while reducing portfolio volatility compared to a pure equity index fund. But how exactly does it do that? Let's break it down. At its core, JEPI holds a diversified portfolio of U.S. large-cap stocks, companies you know like Microsoft, Amazon, Visa, and AbbVie. On top of that equity base, the fund managers use an options overlay strategy. Specifically, they sell covered call options, more precisely, equity-linked notes tied to the S&P 500. By selling these options, JEPI collects premiums, cash paid by other investors for the right to buy stocks at a set price. That money, combined with dividends from the stocks themselves, is distributed to shareholders each month. This is how JEPI generates its famous income stream. Now let's talk numbers. As of 2025, JEPI's dividend yield is around 8 to 8.6%. That compares to just about 1.4% from the S&P 500. And unlike most funds that pay quarterly, JEPI pays monthly distributions. This makes JEPI incredibly popular with retirees, income-focused investors, and anyone looking for regular cash flow. But as with everything in investing, there's a trade-off. When JEPI sells call options, it's essentially capping its upside. That means in a roaring bull market, when the S&P 500 shoots higher, JEPI won't capture all those gains. Some of the growth is traded away in exchange for steady income. On the other hand, in sideways or choppy markets, JEPI often shines. The consistent option premiums act like a cushion, reducing volatility and smoothing out returns. Since inception, JEPI has returned about 11 to 12% annually on average. That's solid, but remember, much of that comes from income distributions, not share price appreciation. Where JEPI really stands out is volatility. Its volatility score is about 13.8 compared to the S&P 500's 21.3. Translation: JEPI is a smoother ride, fewer big swings up or down. For many investors, that stability is worth the trade-off of slower long-term growth. JEPI isn't free. It charges an expense ratio of 0.35%. That's more expensive than a passive S&P 500 index fund like VOO at 0.03%, but pretty reasonable for an actively managed ETF that runs a complex option strategy. Now let's talk risks, because no investment is without them. Equity risk: JEPI still owns stocks. In a market crash, it will drop in value, sometimes sharply. It's not a substitute for bonds. Capped growth: the option strategy limits long-term compounding. Over 20 or 30 years, a broad index fund may significantly outperform. Tax implications: JEPI's monthly distributions are often taxed as ordinary income, not qualified dividends. For investors in taxable accounts, that can mean a higher tax bill. Concentration risk: while it holds over 100 stocks, many are large-cap tech names, so it's not as diversified as owning the entire market. These are important factors to weigh before jumping in. JEPI isn't the only fund using this strategy. Let's compare. JEPQ, JPMorgan's Equity Premium Income, ETF focused on the NASDAQ 100. Same concept, but heavier exposure to tech. QYLD, the Global X NASDAQ 100 Covered Call ETF. It sells at-the-money calls, which means higher yield but even less growth potential. XYLD, a similar strategy but tied to the S&P 500. Compared to these, JEPI strikes a balance. High yield, reduced volatility, but still some exposure to growth. That's why many investors prefer it as their core income ETF. So where does JEPI fit in a portfolio? For retirees or income seekers, it can serve as a reliable monthly paycheck. For balanced investors, JEPI can complement growth ETFs, smoothing out volatility and adding income. For young investors, it may not be ideal as a core holding since long-term growth is capped. A growth-focused index fund could compound wealth more effectively over decades. Think of JEPI as a tool. It's great for income, but not a one-size-fits-all solution. JEPI is also part of a much larger trend. Options-based ETFs have exploded in popularity as investors search for yield in a world of low interest rates and volatile stock markets. In fact, some analysts suggest that funds like JEPI, which are constantly selling call options, are influencing volatility levels in the broader market. Whether you see it as a game changer or just another tool, JEPI is shaping how modern portfolios are built. So, is JEPI worth it? That depends on your goals. If you want steady monthly income and less volatility, it's definitely worth a look. But if you're chasing maximum long-term growth, you might want to stick with a traditional index ETF. If you found this breakdown helpful, don't forget to hit the like button, subscribe for more investing insights, and drop a comment below. Would you add JEPI to your portfolio? Thanks for watching, and I'll see you in the next one.